Welcome everyone and thanks for joining. In this video, I want to share how I view investing during a down market, when the global stock market begins to hit speed bumps and news headlines begin spreading fears about a potential collapse. Now, volatility is a common occurrence in the stock market. One day the market is green and the media is excited for the future of innovation, when the next day the market falls and the news headlines put out claims that the next economic crash is coming. However, September is proving to be a very difficult month for many investors across equity and the cryptocurrency markets. In truth though, for long-term investors, the day-to-day volatility in the markets and news is simply noise. Rather, focusing on long-term investing, primarily in high-quality companies and index funds, allow us to remove some of that fear, uncertainty, and doubt and look at macroeconomics from the big picture. That human innovation and technological progress will always persist long-term. Now, September has not been a pleasant month for most investors. In fact, all three major US indices are down. The Dow Jones, S&P 500, and even the Nasdaq have each fallen about 3% since the start of this month. And earlier this week, we had some of the biggest one-day drops of the entire year. And there are several legitimate reasons for these fears in the US stock market. For starters, the pandemic is still impacting the daily lives of everyone around the world. In the United States in particular, concerns about the Delta variant remain very high, especially considering that we are approaching winter when more individuals stay indoors and are in close quarters. Combined with the approaching holiday season with individuals wanting to travel to see family and friends, it is certainly possible for cases to rise later this year, even with the majority of the US being vaccinated. Additionally, there are still concerns about whether the Federal Reserve will begin tapering and slowing the pace at which the Federal Reserve purchases assets. If the Federal Reserve signals its removal of monetary stimulus, this could impact markets. Furthermore, there continue to be investor concerns over the $1 trillion infrastructure bill and potential increase in capital gains tax. And finally, Evergrande, a massive Chinese real estate conglomerate representing, I think, around 2% of China's GDP, it faces a potentially bad debt default. The company owes over $300 billion, and the management has recently admitted that meeting its financial obligations may potentially be a highly difficult process. Combined with the effects of the pandemic across Asian markets, there are many fears about the stability of the Chinese financial system should Evergrande default on its debt. Now, all of these situations are genuine fears for the global stock market, and many of them aren't good news. If anything, they really are concerning from a socioeconomic, racial, and healthcare perspective. And at the end of the day, these new developments can and will impact the lives of millions around the world. If we begin to zoom out and look at the big picture though, what lessons can we begin to scrape together about how to prepare for a potential market decline in the near future? Let's first start off with market valuations. Although the month of September has hit the three US indices quite hard, the one-year trends show a much different picture. In fact, since September 2020, the S&P 500 has returned well over 30%, not accounting for dividend reinvestment. In the past 5 years alone, the index has doubled in money, returning over 100%. And if we zoom out even further, the S&P has returned on average about 7% annually, adjusted for inflation. So while this sudden drop in market prices is certainly alarming and potentially frightening, and if history is to teach us anything about the past, it's that the general market rises over long periods of time. And yes, past performance does not guarantee future performance, but the global stock market has historically risen to reflect advancements in human progress. And as a result, it can be worthwhile to take a step back and view our investments not as short-term trades that must be profitable within several hours, days, or even months. Rather, it's more ideal to view our positions in longer-term horizons, often over the course of many years. Current events will significantly impact the volatility of the stock market in the short term, but the stock market as a whole will reflect human progress in the long term, for better or for worse. Therefore, it's really important to take our emotions out of the picture when looking at our investments, and staying fully invested has generally been a much more effective strategy for the average investor than attempting to time the ins and outs of the market. Now, as for me, how am I shifting my portfolio to prepare for a potential market decline? And the answer is not too much, actually. In truth, I've kept a consistent investing theme since I started back in 2018 that was inspired by Warren Buffett. I simply prefer to invest in what I know. I actually take it one step further and prefer investing in companies that I'm personally a very happy customer of. After all, that allows me to understand their business model and why it appeals to many customers just like me. In fact, this actually naturally leads me to high-quality companies with a significant moat of safety and several robust revenue streams, let alone additional customer retention rates. Take, for example, a company like Apple. From a stock performance perspective, it's done quite well, but it's not super exciting. However, the company itself provides a level of safety beyond imaginable that's envied by thousands of companies around the world. MacBook, iPad, and iPhone sales continue to dominate around the world, but Apple also further seeks to increase its revenue streams through Apple News, the App Store, Apple Music, Apple Fitness, and numerous other devices and applications. Innovation is just second nature to a technological powerhouse like Apple, and even if there was a substantial market decline, I personally have no doubt that Apple will continue to be as high quality of an innovative company as they currently are. And should stock prices fall, I would actually be very happy to pick up more shares of high quality companies like Apple. And my investment thesis isn't only limited to Apple. I personally believe that all the companies I hold in my growth portfolio are genuinely high quality. Companies like Microsoft, AMD, and Taiwanese semiconductor manufacturing post high revenues, consistent profitability, and innovation in research and development. In my streaming pie, Google, Facebook, and Disney will always still be there in the interactive media giants that they currently are. For commerce, Amazon, Home Depot, and Costco are all likely to continue dominating their respective industries, even during a market decline or recession. And of course, the two US and international stock markets will always be a winner long term. Admittedly, Tesla is probably my riskiest asset of them all, but it does only occupy 4% of my overall portfolio and still is a very high quality automobile and technology company. And finally, I have actually made changes to my financials pie. It still holds the payment processors MasterCard and Visa, the peer-to-peer network PayPal, and the massive US bank that is JP Morgan Chase. However, I have also added a fifth position, and that is Ally Financial, the digital financial services company that owns Ally Bank. I won't be able to quickly cover why I'm investing in Ally right now, but I am really excited to have opened this long-term position and will be sharing my thoughts in a future video. So if you're interested in learning more about why I'm buying Ally, please remember to hit the subscribe button if you haven't already, and stay tuned for more updates. Altogether, I do believe that these 16 individual companies are all high quality positions with strong balance sheets in the event a market collapse were to hit. When a market falls, speculative and risky assets tend to drop the fastest and the hardest. While speculation and gambling on short-term trades provide great entertainment and potentially life-changing results, it is also highly risky and statistically unfavorable when done over long periods of time. And if you do prefer that type of investing, just please be safe when it comes to your financial investments, and don't get lured in by social media into risks that you are otherwise unwilling to take. Focusing on long-term investments like index funds or high-quality companies is generally a statistically more favorable strategy for the vast majority of individuals, and saving aggressively and investing consistently has been the best strategy for the vast majority of individuals throughout history. Now, with all that being said, thank you so much for watching. I really do appreciate it. If you enjoy this type of content, please consider leaving a like and subscribing to the channel. As always, I'd love to know your thoughts on how you're handling this recent market decline. If you would like to jumpstart your investment journey with some free stocks, cash, or crypto, feel free to use the affiliate links down below, and links to my portfolio changes can always be found below in the description as well. Again, stay safe, stay healthy, and have a great rest of your day. Bye.